So the Japanese economy is facing hell and they are admitting it. Ever since Japan ended negative interest rates, things haven't been going on so well. The stock market is down, showing investor confidence is slipping. But a bigger concern is the Japanese yen, which despite multiple threats of intervention, is still collapsing. So what's going on in Japan? It seems that all the G7 economies except for the US are starting to collapse. Germany is finished, the UK is in recession and Japan is in big trouble today. Kishida, the Prime Minister, he's already starting to waver. He knows the rate hike isn't saving the economy, it's not even saving the yen. And from his latest news conference, he seems very, very confused. He wants the Bank of Japan to maintain monetary easing, which means to keep printing money to buy bonds. Kishida still needs yields to stay low or this mountain of debt will collapse. And this is where things just get bizarre. Preventing a recurrence of deflation is the purpose of my administration's existence. Now he's talking out of both sides of his mouth. He wants to fight deflation, but he's afraid of higher inflation. And this is more confirmation that Japan's economy is trapped. Japan's debt to GDP is over 260%, the highest of the entire G7 club. And this is an enormous burden that's preventing the BOJ from raising rates higher. Since 2013 and 2016, the Bank of Japan has been buying an incredible amount of bonds to push yields down. The goal was to stimulate the economy. Not only did that fail, it ballooned the bank's bond holdings to over 600 trillion yen. There are people still saying that the debt burden doesn't matter for Japan, but it absolutely does. It drains away their fiscal budget. Instead of spending money on increasing production, they have to service this massive debt. Thanks to the rate hike, interest on the debt is only going to grow. This amounts to 27 trillion yen or $180 billion, is equivalent to a quarter of the entire annual budget, more than 3 times Japan's defense spending. Interest rates can't possibly rise higher in Japan. Now, getting from negative to 0% is one thing. Hiking it further to 2 or 3% is a completely different animal. It will implode the debt crisis and turn Japan into a financial wasteland. Because Japan is caught in this limbo, they're going to face the dual threats of US interest rates and cheaper Chinese goods. Cheap Chinese exports are flooding the world, which take away market share from Japan. At the same time, US interest rates are going to stay high, and that is going to drain away value from the yen. Japan's currency is going to stay weak, causing prices to soar. Japan is no longer the third biggest economy in the world, and as you'll see in a bit, is going to stay this way for quite a while more. And let's talk about China's export risk first. Now, there are three big manufacturers in the world: Japan, Germany, and China. At the end of the day, it all boils down to price, and this is one arena where both Germany and Japan can't really compete. Japan's March factory numbers are signaling trouble, coming in at 48.2. Anything below 50 is contraction and is screaming stagnation, and this is during a time where the yen has collapsed by 20%. So why are factory orders down? Shouldn't exports be cheaper? It's because the cost of manufacturing in Japan is just too expensive compared to China. If you have two products of the same quality, the only arena left to compete in is price, and the cheaper product always wins, especially as the global economy slows down. While Japan is stagnating, China's industry is rebounding. The March PMI is flying up. It has risen above 51 from 49, which is a very big jump in one single month. PMI is a leading indicator which shows economic growth is starting to return to Beijing. And this growth, interestingly enough, isn't coming from domestic consumption. A big part of this is driven by export demand. Exports from China rose by 7.1% in January and February, almost 4 times higher than the estimates. A big part is the trade with BRICS, especially Russia. Russian imports come directly from China, from cars to computers, all these are Chinese made. In return, China imports a ton of cheap energy from Moscow. Since 2021, Chinese imports of Russian oil has been rising. Russia has overtaken Saudi Arabia as China's top exporter, supplying over 100 million tons last year. The majority of this oil is through the pipelines, and the discount can be anywhere from 10, 20, or even 30%, which makes all the difference. And this allows China to compete with Japan even though the yen is collapsing. Manufacturing in Japan is getting really expensive today. The chipmaker TSMC is setting up shop in Kunamoto, Japan, but that's only after getting $5 billion worth of subsidies from the government. This move is done for geopolitical reasons, right? It's not really about economics. The cost of manufacturing based on energy alone is much higher in Japan than in Taiwan. Just the residential power rates are off the charts. In Taiwan, it's around 2.5 Taiwan dollars per kilowatt hour. In Japan, it's $7.50. That's triple the cost of energy just to keep the lights on. It's much worse when it comes to industrial power. The price of oil is also starting to rebound towards $90, and this is bad news. The cost of manufacturing in Japan is only going to soar. You have the price of the commodity itself going up, which is oil, and a weakening yen. This will make energy imports to Japan doubly expensive. Manufacturing will be less competitive. So it's not a coincidence that Japan is still importing Russian oil above the price cap. The US has given Japan permission to keep importing crude till June 2024. Biden has allowed Japan to keep imports from Russia because without it, their manufacturing would collapse faster than Germany. A big driver of any economy is domestic consumption. Your own people, your own population needs to buy your stuff. Japan, however, is unlike the US where everyone just swipes on their credit cards. It's embedded into their culture to save money. Even before the rate hike, Japan's household consumption has been collapsing. Household spending crashed by 6.3% in January. Spending declined for the 11th straight month, which is astounding. Japanese households aren't consuming because there's simply no incentive to. I need to re-emphasize this point. While Japan is in the G7, the Western club, it is still an Asian country. People would rather save money even though inflation is sky high. The Japanese currency is collapsing, which is making prices fly to the moon. Since 2022, the yen is down by 26%. Japan imports almost everything to their island nation, from food and electronics to oil and gas. Japan is dependent on imports, and all these are priced in a dollar. The average Japanese consumer can buy 26% less stuff with their currency today versus 2 years back. If you are in Japan, you have very few options left. If you're rich, you have tons of money. Sure, you can convert your yen to US dollars and put them in treasury bonds, but not everyone is fortunate enough. Most people would simply save their money and cut down on consuming stuff. And that's why stores are empty and the economy is stagnating. Now, it's true that inflation is only at 3%, right? 3%. That's the official number that Japan shows to the world, but it's just smoke and mirrors. We need to look at the real wages. What do people take home at the end of the day? And it's not looking good. After adjusting for inflation, real wages have fallen in January by 0.6%. In other words, as a wage earner in Japan, you're poorer today than a year ago. It's impossible for real wages to climb if the Japanese yen keeps collapsing. But the BOJ is trapped. If they hike to 2% or even just 1%, that might be enough to collapse the entire national debt and companies as well. And this chart tells us the big crisis people in Japan are facing. All the salary men in Japan are facing a cost of living squeeze. Corporations might be making a ton of money, but people on the street they are getting clobbered. Since 2013, when the BOJ started buying bonds, inflation has been rising faster than wage gain. Prices are up by 12%, but salaries have risen by only 5% at best. There's a big 7% gap that's getting bigger and bigger as time goes on, but this time it's going to get much worse. Not only does Japan have positive inflation, the yen is still collapsing despite the BOJ stopping yield curve control. The Japanese consumers getting pummeled by both inflation and a weakening currency. And if this was a wrestling match, consumers are getting chokeslammed by both Kane and The Undertaker. There's no getting up from this smackdown. They're going to hit rock bottom and it's a real stunner. Here's the trillion yen question now. Can Japan save the currency? For almost a week, we have been hearing multiple threats from the BOJ. According to their forex chief, it's not Japan's fault that the yen is crashing, it's all those evil speculators. The recent weakening of the yen cannot be said to be in line with fundamentals. We will take appropriate action against excessive moves without ruling out any options. However, is that really the case here? There are many fundamental reasons why the Japanese yen is collapsing. The first is the interest rate differential between the US and Japan. In other words, the gap between US interest rates versus Japan's rates are just too high. Even though the BOJ has ended negative rates, just look at the big gap between the Federal Reserve, the Fed funds, and Japan's benchmark rate. There's still a huge gap of 5.5% here. If you're an investor, you dump your yen to buy US dollars and then invest those dollars in treasury bonds. You'll get 4 to 5% risk free. And it is this selling that's putting more pressure on the yen. It's not really rocket science here, right? Blaming the speculators is one very easy excuse. I get it. You need a boogeyman for currency intervention. So the scapegoat this time is investors betting against Japan. But there's another reason why people are betting on the yen collapse is because inflation is going to be a structural problem going forward. In Japan's case, to combat inflation, you need to raise interest rates high enough, and this will drive money from overseas investments back to Japanese assets like JGBs. You need to move the money from overseas back home to Japan. And just in the US alone, there are over 71 trillion yen or $470 billion offshore. Raising interest rates will lure this cash back to Japan, which means buying up more Japanese yen. And that will be the only structural way to reverse the yen's weakness. But that is impossible due to the debt situation. Raising rates beyond 0% can really collapse this entire house of cards. The only strategy left is a currency intervention. Japan is planning to dump their US dollar reserves to buy back the yen to prop it up, and this is a knee-jerk reaction that will feel long-term, but it is the only card they have left to play. The yen has weakened beyond the previous intervention levels. The last few times Japan did a dump was when the yen was around 150 against the dollar on average. We are now at 151.7. That's well above the levels for intervention. A currency dump could be happening in a matter of days or even hours. Japan is desperate to save its currency, but this is just a stopgap measure. Now, back in 2022, Japan did three official interventions. The biggest dump was 5.6 trillion yen or 37 billion US dollars. They sold dollars to buy back the yen in the open market, but that only strengthened the currency by 4% at best. That's nothing compared to the overall 26% drop. Currency interventions won't work because the fundamentals are against Japan. Trade is being lost to China, so demand for yen is down because of the Federal Reserve keeping rates higher for longer. Investment money is flowing to the US. Demand for the yen gets hammered down even more. If there's one chart that shows Japan's crisis, it's this one. Japan's basic balance is crashing fast. Even though they have a decent current account balance in pink, investment money has gone negative. Direct investment is leaving Japan. Portfolio investments are down, and financial instruments are betting against Japan as well. It's causing Japan to lose a ton of money. Just in January alone, more than 2 trillion yen has fled Tokyo. Money flowing away contributes to a weaker yen. So retail investors have given up hope. Institutions are betting against Japan as well. It's one downhill ride until the Fed slashes rates hard, and it's going to take at least a few more years before that happens. On the manufacturing side, it's also getting untenable to make stuff in Japan and ship it out. In December, Japan agreed to buy US steel for $14 billion. This is a very gigantic acquisition that only highlights the problems back in Japan. Demand for steel products and in general, they are collapsing back home. Manufacturing in the US is cheaper and there's access to a bigger market. So Japan is starting to deindustrialize, and the big winner ironically is the US. And the longer this continues, more industries will leave Japan and head over to America. It's just like Germany once again. Because of its enormous debt burden and a decade of negative rates, Japan is trapped. They are battling a currency crisis, an inflation crisis, an energy crisis, and a consumption crisis. The currency intervention isn't going to work in the long term. It's a fairy tale strategy. The only hope left is for the Fed to slam rates down in a hurry, but chances are slim to none, as Slim just left the building. But as always, let me know what you think. Will Japan do a massive dollar dump to save the yen? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.